Enron looked like one of the smartest companies in America. It was praised. It was admired. It was treated like a symbol of innovation, growth, and modern business success. Then it collapsed. And when it collapsed, more than $74 billion in shareholder value was wiped out. But Enron did not fall because of one bad quarter. It fell because much of its success was built on an illusion. The company looked powerful from the outside. Inside, it was hiding debt, inflating strength, and using accounting structures that made the business appear healthier than it really was. This is the story of how Enron became one of the most infamous corporate frauds in history, and why so many people trusted it right up until the end. To understand Enron, you have to understand how powerful its image became. In the late 1990s and early 2000s, Enron was seen as a brilliant company. It was not just an energy company in the public mind. It was framed as something bigger, a sophisticated, fast-moving business that represented the future. It talked about innovation. It talked about trading. It talked about modern markets and smart strategy. The company seemed advanced. And that image mattered. Because when people believe a company is brilliant, they stop questioning it as hard. That is where fraud becomes more dangerous. Not just in the numbers, but in the story. Enron built a story that people wanted to believe. Investors believed it. Analysts believed it. The media praised it. Employees believed they were part of something extraordinary, and the market rewarded that belief. But underneath the image, the business was much weaker than it appeared. One of the biggest issues was debt. Enron had obligations and risks it did not want clearly visible. So instead of letting the outside world see the full weight of those problems, it used structures that helped push some of that burden out of plain sight. This is where the mechanism matters. Enron used off-balance sheet entities and special structures to move liabilities away from the main company view. That made the company look cleaner and stronger than it really was. To an ordinary investor, the company could still appear healthy. But the appearance was misleading. That is one of the central lessons in the Enron collapse. If a company is using financial engineering to make reality look better than reality actually is, the surface can stay attractive for a while. But the truth does not disappear. It builds pressure in the background. And eventually, the pressure comes back. Enron also used accounting methods that helped it recognize expected future profits early. That made results look stronger in the present. So even when the underlying economics were not as solid as they seemed, reported performance could still look impressive. That gave the market more reason to keep believing. And belief is powerful. Because once investors believe the growth story, they often stop asking how durable it really is. This is where the psychology of the collapse becomes so important. Enron was not only selling energy or managing contracts, it was selling confidence. Confidence to shareholders, confidence to analysts, confidence to lenders, confidence to employees. And confidence can hold a weak structure together far longer than it deserves. As long as the image holds, the machine keeps moving. The stock stays elevated. The praise continues. The incentives stay alive. But once confidence cracks, everything changes. People start looking closer. Questions get sharper. Trust weakens. And once trust starts breaking in a fraud story, the decline can accelerate fast. Enron had another layer of danger. Its leadership and culture helped reinforce the illusion. The company became known for aggressive performance pressure, aggressive presentation of success, and a culture where appearing strong mattered enormously. That kind of environment can become toxic, because when the organization rewards the image of success more than the substance of success, distortion grows. People become afraid to show weakness. Bad news gets buried. Risk gets rationalized. And the company starts managing appearances instead of reality. That is a dangerous shift in any business. At Enron, it became fatal. The company kept projecting strength, But the structure underneath was not nearly as strong as the public believed. And while investors saw a high-flying business, many employees were deeply tied to the company in a much more personal way. Some had retirement savings connected to Enron stock. That made the collapse even more devastating. Because this was not just a market story. It became a human story, a trust story. Employees believed in the company. Many ordinary people believed that the company they worked for was solid and future-facing. Meanwhile, key executives were in a much better position to understand the truth. That betrayal is one reason Enron still hits so hard. It was not just that a company failed. It was that many people trusted the image while the underlying reality was far worse. As cracks widened, scrutiny increased. More questions were asked about the company's structures, disclosures, and reported health. And once that process began, the illusion became harder to maintain. Because complex financial engineering can confuse people for a while. But eventually, the mismatch between image and reality becomes too large to hide. That is what happened here. The market started losing confidence. The company's credibility deteriorated. The stock collapsed. And once the trust was gone, the whole structure came apart quickly. In late 2001, Enron filed for bankruptcy. At the time, it was one of the largest bankruptcies in U.S. history. And the fall was stunning because the company had looked elite just before the collapse. That is why Enron became such an important symbol. It exposed how dangerous corporate storytelling can become when it is backed by distorted reporting, hidden obligations, and incentives built around keeping the illusion alive. It also showed how weak oversight can allow that illusion to grow for too long. The warning signs were there. But the company's image was so strong that many people did not fully process the danger until it was too late. That happens more often than people think. When a business becomes famous for being smart, the market can become less skeptical. Complexity gets mistaken for sophistication. Opaque reporting gets tolerated because people assume the company must know what it is doing. Confidence turns into protection, and that protection gives fragile systems more time to keep operating until they break. Enron's collapse also changed how people thought about governance, accounting, and transparency. Because this was not just a story about one company making mistakes. It was a story about what happens when incentives, reporting, culture, and image all line up in the wrong direction. A strong business can survive scrutiny. A weak business depends on avoiding it. Enron depended on the image surviving. Once that failed, there was very little real strength underneath to save it. That is the executive lesson in this collapse. A company can look brilliant, modern, and fast-growing while hiding deep structural weakness underneath. If leadership is focused on protecting the story instead of confronting the reality, the organization becomes more fragile with every passing quarter. That fragility may not show immediately, but it accumulates. And when the break finally comes, it is often far more violent because the market had been believing the wrong thing for too long. Enron looked like a breakthrough company, but much of its strength was manufactured. It looked profitable. It looked innovative. It looked untouchable. But the image was stronger than the foundation. And when truth finally forced its way through the numbers, one of the most admired companies in America became one of the most infamous corporate frauds in history. That is why Enron still matters. Not just because of the money lost, not just because of the bankruptcy, but because it revealed something deeper about business failure. A company does not need to look weak in order to be weak. Sometimes the most dangerous collapses are the ones hiding behind prestige, complexity, and praise. Enron proved that. It looked successful. It was not. And when the illusion ended, billions disappeared, trust was shattered, and one of the biggest fraud stories in corporate history was exposed. If you want more breakdowns on the biggest corporate frauds and business collapses in history, subscribe and watch the next video.